Self-storage in 2026. What is going to happen to this industry? The self-storage industry has been hit really hard over the last 3 to 4 years. And in 2025, we saw the bottom, or a stabilizing effect across the industry. We're going to get into and show you exactly what drove that stabilization. Now, 2026 is the beginning of the reversal, and we know that because we already started to see it. There's a few main drivers, which we will explain and go into, that actually show us what is happening to self-storage. I've been in self-storage since the early 2000s. After 2008, we really upped our business and started buying through 2010 and beyond. We went through COVID, and we prepared in 2021 for what I called the self-storage bubble. And we knew it was going to be difficult. A lot of people got out of the game. But these are cycles. And these cycles are actually something that we can see and look at. Not because we're predicting the future. That's not what's happening here. But we recognize what actually makes the business run and work on a day-to-day basis. And these things follow cause and effect. We've seen it through the cycles. 2008, COVID, the buildup from 2015 and on. We amassed over $400 million in assets, and we're across 12 states. We own and build software systems within the industry, and we pull huge amounts of data, and we are looking at this industry from not just the storage owner, but from the actual operations and from the outside, looking in, the servicing of the industry. This is an industry that I specialize in. I wrote the 2 best-selling books on self-storage and exactly how to get into the industry, own and operate. And today, we're going to give you our 2026 forecast and beyond. I'm going to break down in 7 sections what is happening and what it means, so you can know and understand very clearly the drivers. This allows you to actually look at and understand individual markets, as well as knowing what is going on in the whole space, things that you have no control over. Those are the most important things to know and understand. Understanding what made the problem is actually what will get us out of it. Right now, we are currently acquiring a lot at the fastest pace that I've acquired since 2009 and 10. We are buying deals that are severely under replacement cost. We just acquired 2, for example, that were roughly about 18 million. It would cost me 14 to 15 million to replace one of those. We're also buying others that are severely under replacement cost. And these are not small mom and pop facilities. We're talking about multi-story Class A assets in major markets like Dallas-Fort Worth. But it doesn't matter if it's a small town like I own in small towns, small assets, or a big city. The differences in them are not what is affecting the whole industry. Now, they do act very differently, and there's pros and cons to each. But at the end of the day, the industry outlook will be very similar, and it will tell you what to look at when you're looking at investing in storage. These are cycles. They are not quick. They take time, and most people cannot survive through the cycles. This is why in 2021, when we were getting ready for the self-storage bubble, we refinanced and took huge amounts of cash out so that we could be stable and take care of in down times. And that is also why right now we are buying at mass. It's the same predictors and indicators that led us to stop taking debt in 2007 and 6 and really start piling on and acquiring and taking on debt in 2009, 10, 11, 12, 13. It's important to recognize that this is not 2008. The economy is nothing like 2008. But for storage, there are huge similarities. In fact, in storage, some aspects are worse than they were in 2008 when we were owning and operating. The last 3 years, we have seen a drop in rents that were far above and beyond anything we saw during the Great Recession. So what happened? How did we get to 2025? How did it stabilize? The first thing we're going to talk about is the actual drivers, and this leads us into section 1. It's important that you realize and understand the 6 Ds of self-storage: dislocation, divorce, death, downsizing, decluttering, and distribution. Now, when we look at this, it's important to know that although they are individual, there are some, like dislocation, distribution, that are very, very closely tied to the same driver, including downsizing. This represents roughly 45% of our industry. And when I say 45% of the industry, I mean 45% of new tenants, our actual customers, where that demand comes from. That is transactions, housing, and moving. This is what killed and what we looked at to say self-storage is not only in a bubble, the crash is going to be really bad on rates. Why? Because with all the printing and inflation, we knew interest rates would have to go up. Not predicting the future, just knowing interest rates would go up. And what we did is we pulled a bunch of Wall Street data and we looked at the underlying mortgages. And at the time, it was something like 96% were locked into 30-year mortgages at under 4% by far, but 3% and under. Now, that is very different than in 2008. In 2008, it was floating rates and people lost their homes and housing prices crashed. That is what signaled us during that time that this was going to be worse. Because what it meant would be that nobody would move. And in an inflationary environment, that home and that mortgage would actually rise in cost. We didn't have a surplus of homes. We actually didn't have any. And so the people that had that 30-year, 3% mortgage, which made up over 95% of the market, that was the asset. Housing prices continued to increase. That meant homeowners' wealth and equity grew and had been growing. We're talking about the largest equity in homes that we've ever seen. And the underlying vehicle, that 3% 30-year mortgage, secured it. What that meant for storage was bad. It meant that people wouldn't move. It's actually better for self-storage if people lost their homes and did move. It created transactions and movements. And we saw this. Overall, housing transactions dropped below 2008. So 2025 is where we saw that stabilization. These numbers are very important for us to realize. We're talking about 2021, where it was the peak. We had 6.12 million home transactions. Take that to 2025, where we had 4 or under. That's roughly a 35% plus drop in housing transactions. That's a crater. Like that just drops like a rock off a cliff. This drop continued from 2022. We saw a 17% drop. 2023, we saw an 18% drop. And 2024, we saw a 3% drop in housing transactions. And in 2025, it stabilized. It didn't just stabilize. For the first time, it actually picked up. Now, it's been slight this year, but it did. It went up. That's a big difference from dropping at double-digit rates to turning and going up 1.5 to 2%. This stabilization period where the drop slowed down in 2024 to actually slowly picking up in 2025 was with minimal reduction in interest rates. Although interest rates have been coming down, yes, the overall 30-year mortgage went from spring in 2025, like 6.8 to 6% now. That's a big drop, but it didn't happen across the whole year, meaning that huge period of time it was 6.8. So the data we pulled was simple. We looked at roughly 10 of our large assets that represented thousands of units across multiple states and tied that into 100 storage facilities across the United States that were not ours. And we pulled the data, and I could accurately predict with 95% confidence, based upon a 10 basis point drop in interest rates, what move-ins would do. And we took all those facilities, we're talking about, tens of thousands of units, and with every single drop, a 10 basis point drop in the overall 30-year mortgage, you would see a tick up in move-ins. So what we saw in spring is that 6.8 went to 6.5, and there was a surge of move-ins. Now, as summer went on, it went from 6.5 back up to 6.8, and the inverse happened. Move-ins dropped. Now, fall, this shifted. We've had one of our strongest falls that we've ever seen. In fact, our fill-up facilities that we opened up, development, have tons of units that are open in 2025. They have had up months every single month, even during the fall, because there's a busy season and a slow season in storage. The busy season is spring through summer. Why? People are moving. Fall, school starts, everybody stops moving, and occupancies go down, rents go down, and your move-ins actually go negative for the most part. Now, we saw the opposite. They kept going positive. That was purely driven due to the interest rate dropping. Now, 6% is still astronomical compared to where it was. This is what's important to understand why it's not like 2008. In 2008, it went from 6% to 3%, and that did nothing. Why? Because an interest rate doesn't matter if you can't get the money or the debt and deploy it. It doesn't matter if it's 10% or free, literally zero. If I can't access the debt, the interest rate doesn't matter. Today, there's tons of cash on the sidelines and a lot of people that are qualified. We don't have bankruptcies. We don't have mass unemployment. That means the sensitivity to interest rates is extremely high. Hence the reason why we see those movements, and it's so correlated with interest rates, even up to just a 10 basis point drop. So what that tells us about today in 2026. First and foremost, we do not need interest rates to go back to anything like they were to have an effect of increasing move-ins. The difference of 6.8 to 5.5 is massive. Every point you go down, millions of people can now enter into the home market. Every single point. There's still huge amounts of people that can't, but you're opening it up from being so high. That's millions and millions of new customers. Even though it may be a small amount overall, that tranche of people that can now access overall is big. And moving into 2026, that is expected to increase. Now, why do we have the confidence of the expectation to it increase? Because we have seen it increase every month during the fall as interest rates have come down. Now, we also know that we have a Fed that just lowered interest rates. As the time of this recording, it happened last week. This is going to come out a little later. Lowered interest rates by a quarter point. Now, when we look at next year, whether interest rates will go up or down, first of all, we don't actually know. And second of all, we can look at who's making the decisions. The current Fed chair is leaving in the spring. We know we currently have an administration that is obsessed with interest rates because that is the fuel for the economy. In fact, they've been very clear they think that it should be 3% lower. That means a massive shift. I do not think that's going to happen. Not even close. Not even close. That would cause inflation like crazy. But because of that sentiment, we do know whoever they hire is going to be very singular focused. Interest rates need to come down. How much? I don't know. But once again, we don't need a ton. We just need a gradual slowing. It would actually be bad if it came down a ton and then we had inflation spike up and they jumped interest rates again. So we don't think this is a light switch. We don't think 2026 is going to be a major boom all of a sudden in demand. But that's not the only thing that's working here. That's just one piece of the pie. But currently, the National Association of Realtors is projecting plus 14% in housing transactions. That is a major jump. That leads us into this correlation. You see, they track interest rates so closely, we can actually see rates nationwide and how they've tracked overall interest rates, where they really peaked out in 2022, spring 2022. Interest rates came up, and on an average, that was $110. The national average is down to $75. The actual rate, that monthly street rate for a storage unit, that is a major drop, a 32% reduction in overall street rates for storage. But that's on a national scale. I have some locations that market saw a 60% drop in many unit sizes. And this is one of the key differences of today versus 2008. Because you see, in 2008, people didn't lower their rates nearly as aggressively. We saw occupancy drop more. But people didn't lower their rates aggressively because there was no point in getting in someone so cheap that you couldn't pay your bills. So why did that change? Well, today, the industry is much more consolidated. Now, we have Wall Street that is really looking at this industry. We have major REITs, private equity, and everybody else. And they found that demand for storage on a unit is not the same when you have someone that's looking for one and someone that's already there. You see, demand when you're buying a unit, price is a major factor. Once you're in it, it's not nearly as much of a factor, meaning that the price elasticity of that buyer changes when they're in. What that means, drop them low because people are sensitive to prices. Once they get in, they're not, and then you up the rate. So people dropped rates to get people in, and then they jacked up prices once they were in, leading to their overall in-place rate being higher than their street rate. This is not something we like, but this is the way for the major REITs. So when you have a major REIT or a major player that comes in and they opened up new inventory right as occupancy is falling and rates are falling, they need to fill up. So they just crater rates, give them away, because once they got them in, they're going to lift them up. This wreaked havoc on self-storage rates, especially in markets that were overbuilt. And we can see that correlation here. Now, although the street rates went down, a lot of the national operators didn't see revenue or NOI drop down nearly as much. Why? Because they were upping their in-place rates so much. Now, a lot of operators, we don't like to do that. We don't like to move somebody in for $50 and then give them rate increases within the first 6 months to $200. And so that put people kind of at a disadvantage. Also, it put people behind the ball, where the REITs were swapping in new customers at crazy and kicking some out and lifting the rates of others super aggressively. But like I said, this mostly happened in markets that had excess space, meaning that if you were in a market that didn't have inventory to begin with, you had lower occupancy, but there was no need to compete as much. Lots of small markets saw this. They didn't see major rate drops because there was no new inventory at all. So although demand went down, it was relative, because in markets that had new supply, demand went down, but supply went up. And this leads us to number 3, the big driver. This is a long-term driver. Those interest rate drivers are quick. Interest rates go up, housing transactions go down. Moving into 2026, it's a new world. There's been a 51% drop in construction starts. In 2023, there was 65 million construction starts. Now, I know what you're saying. Hold on, AJ. I thought the peak was in 2021. It was. And this is why construction is a long-term trend. You see, in 2021, starts were lower, but rates and occupancies were so high. Guess what developers did? They went out, they got the money, and they started developments. But developments take time. You got to get the land approved. You've got to actually build the site. You've got to do all of these things. There's a 3-year swing. So when they start, there's 3 years before they hit the market. And so what happens is, as occupancies and rates are going down, you still have new facilities popping up that started when things were great. This acts as an accelerator for dropping rates. It oversupplies markets that already had rates that were dropping, but you can't stop it. Now, that swings the other way. For example, in 2023, roughly 65 million net rentable square feet hit the market. When we look at 2026, it's 28 million that's being projected to hit the market. It cratered. Why? Higher interest rates, lower occupancy, lower rates, new buildings, supply. Actually, the cost to build didn't change much, so it's not feasible anymore. You can't make money. That new supply pipeline takes time to recover, but it has to recover based upon rates going higher and occupancy. So by the time rates and occupancy hit top, the development starts again. Huge swings. That's why they're currently Yardi, StoreTrack, and REITs are currently predicting that we will keep dropping till basically 2030, meaning they may start back up in 2028 or 2027, but it's still that pipeline's dropping until they can all get started and go back again. These create the big swings in real estate. Oversupplied while they're dropping demand. Undersupplied while there's tons of demand. This is what happened in 2008. It creates years of bad years and then years of robust NOI growth. Limited supply, higher demand, making those occupancy and rates go up. This is why we said 2025 stabilizing and 2026 is the start of the new transition, the new trend. Because the supply pipeline and collapse is cratered because a huge percentage of the people that are developing storage aren't even storage people. They're developers. This is what's happening. I know I can develop for $100 a square foot, let's say. Actually, let's make it higher because most of these, let's say it's a climate controlled storage facility that's a big one, they want to sell to a REIT. So it costs me $150, $160 to develop. I can go get debt. It'll cover basically all of it. And then after it's constructed, I need to roll that into a perm loan, not a construction loan. Well, all the developers start to roll it into a perm loan. Occupancy, rents are down, and interest rates are double or triple. They're underwater. And this is why I mentioned at the first, we're buying so much. We're buying deals that are severely under replacement cost because they're losing them. But this also has another effect on the banks and financing. They just shut down risk. And over the last 2 years, that's what we've seen. They're not allowing developers to go out and develop. So what we find is developments that are happening are by storage people like us. We're developing to own and operate, not to flip. Because those developers, once they opened their doors and got that certificate of occupancy, when times were good, they were selling it for a 5 cap as if it was full, turning that $150 development cost into a $250 sell. They were making huge amounts of money and they put very little down. The time for speculation ended and was over, and most of them didn't even know it was over, and they were already starting. Now, obviously, real estate, and a lot of this is centered around interest rates. What I've mostly been talking about today is the intrinsic value. What does intrinsic value mean? So it means you buy it and it makes a certain amount of money. What you get, that value you get, what it pays you, that's intrinsic to the asset. Lower occupancy and lower rates mean you're making less. Your intrinsic value is dropping. You're making less. But interest rates have another effect, and that's the extrinsic value. What is the extrinsic value? The price of the thing. So the price of the stock or the price of the asset on the market, what a buyer is willing to pay for it. When interest rates are down, they can pay way more for the price of the asset, pushing prices up. Even if intrinsic, the underlying value, didn't go up. The same happens in reverse. When interest rates go up, buyers can pay less for that same amount of money that they would have bought, making the price of the assets on the market drop. Now, our forecasts are in line with other major forecasts, and that's that we do not expect interest rates to return to their lows. We expect a very gradual, low interest rate drop. So we're looking, saying maybe by 2028, interest rates on that 30-year mortgage will go to 5%. Maybe 5.5, 5%. We'll see. But because of the things that I talked about at the first, that sensitivity, the housing market picks up quickly. And the difference between 5% and 7% is massive. But it also affects people buying. As occupancy rises, rates rise, and interest rates come down, buyers come to the market. They want to buy. This is reflected in a cap rate. A cap rate is how you view self-storage. It's how we value it, just like all commercial real estate assets. I'm going to make this simple. You buy a property for $1 million. That's what you're going to pay for it. It makes $100,000. You just paid in a cap rate term a 10 because you're getting a 10% return. Now, if that cap rate on that $1 million facility drops from a 10 to a 5, the price just went to $2 million because you're getting a 5% return on that same $100,000. That means just by the market going up in price, interest rates coming down, you made $1 million even if nothing happened. That is what fueled the bubble when interest rates just went so low that prices just kept going up, cap rates kept going down. As we see a gradual slope in cap rates, it's important to know these are not distributed equally, meaning in small markets with small facilities, you have to pay a higher cap rate because there's more risk and you need higher cash flow. Now, if you're in a market that has no supply, Class A asset, they're going to pay a much lower cap rate because it is a safer bet, but also because of the players. Institutions get cheaper money, so they can pay a lot more. They don't go into small markets and third-tier markets, so those cap rates are high, and they'll remain high. The spread is big. We're talking about the difference between an 8 and a 9 cap and a 4 and a 5 cap. And as interest rates come down, institutions, everybody starts paying more. Cap rates come down. Now, I should state, we don't buy on cap rates, meaning I'm not buying something and saying, oh, the value is just going to go up in time, meaning the market's just going to make us money. We don't do that. We look at intrinsic value. But it is an important thing to look at because that changes the market of not only buyers, but developers and everybody else. So over time, we have the opposite of what happened to the drop. Cap rates went up, meaning prices went down. Occupancy went down and rates went down, furthering that decrease in value. That causes prices to drop off a cliff. The same happens in reverse. Occupancies go up, rents go up, meaning the NOI, which cap rates are based on, goes up. And then interest rates, because they're going down, more buyers, prices go up, but cap rates go down. That is a wealth explosion because you're getting it on both sides. And one, intrinsic value, the underlying NOI, fuels that leverage of that cap rate. Meaning, once again, if you buy a facility for $1 million, it makes $100,000, and that $100,000 goes to $200,000, it's now worth $2 million. But also, if the cap rate that was a 10 goes to 5, you get that on top of it. Now, all of a sudden, it's worth millions more than you bought it for. You have a $4 million facility. So these two things combined, along with the other things, create ginormous swings up and down that are really big in the real estate market. And people get trapped in them. We are coming out of that down swing in self-storage. Both intrinsic and extrinsic value are now changing. Supply is being limited and demand is starting to grow again. Why? Just because of basic activity. Now, you got to remember, you may say, oh, the economy is going to go down, right? Stock market's going to crash. The GDP's been growing. The stock market's been going up. People are getting pay raises, yet storage values went down. Those two things aren't necessarily correlated. In fact, If we had a recession and they dropped interest rates, that would be really good for storage. Even if people are losing their homes or moving into apartments or whatever it may be, they're moving. That's still good for storage. And when you have that on top of limited supply, that increases that demand exponentially. This leads us to the recovery. As we have talked about for the last few years, I do these videos and give an update. I also write on it that in 2025, we were having a stabilization period. 2026 is the beginning of the recovery. And then you move into 28, 29, 2030. So 27 through 2030, that is an expansion phase. And then you get started back in the development cycle. Now, this is an overall look of the cycle. And it's important to remember that these cycles repeat themselves over and over and over again for all the reasons I just mentioned. And that's how we can measure and learn from it. It's not about timing the market. It's about understanding the asset and what makes it money, meaning the business. How many customers do you have? How many competitors do you have? What will they pay? And why are they buying? And because some of these inputs are so fixed and so strong, like supply and development, you can see when the supply side's constrained. You can also see when overall demand's at its lowest point. The interesting thing is the actual consumption of storage as a percentage of the population has only ever risen. Not by a lot, but it's still risen. More people today use storage than they did 6 years ago. It's relative to supply, though, and those overall market swings. New customers, interest rates, housing transactions. But still, on average, more Americans use storage. That will continue because storage is not driven just because we're hoarders, which we are, or Americans are hoarders, but also because limited real estate, more expensive real estate, and regulations on real estate drive self-storage use. People can't buy as much, but yet the cost of consumption, moving, play, all of that has gotten more easier over time. So we have limited space. What you can do with that space is very regulated. You need space at a cheaper rate. That's where storage comes. And that's why it's done so well since it began in the 1980s, late 70s, 1980s. HOAs, government restrictions, increased housing cost have all driven storage. But here's the important part. Not all markets are the same, everybody. There are markets that are still oversupplied, and that will take more time for them to come back. Why? Because they had a much bigger development boom. There are markets that are undersupplied because that development and new supply was not nearly as big. You also have migration. Some areas attract more people, and people are moving to those areas, making transactions and movements higher. So when you get into a spot where you have a market where people aren't moving and it's oversupplied, it gets very hard for that individual market to increase overall demand, therefore increasing occupancy and rates. This is a time where, yes, the tide's moving the opposite direction, but you can still get caught because the market that you're in is what dominates the outcome. Overall trends will push markets, demand, and control supply. But the individual market can be oversupplied or undersupplied. This is what makes great buying opportunities like we're doing today. We're buying in markets that were oversupplied. They've kind of bottomed out, but now we can buy deals that just came out or CO or whatnot at really low prices, catching it right as constraint is being caught. But yet these are still markets where people are moving to and have been long-term trends that are above national average. That means we have lower than average supply moving forward, higher than average movement, and our basis to our assets are really low, creating a wealth explosion. The exact same thing that I did after 2008. We're repeating our model. This is an opportunity that doesn't come around very often. We're talking maybe every 20 years. In fact, we're shocked that it happened so soon after 2008. The reason it happened so too soon after 2008 is largely because of how bad 2008 was. That created surplus of government spending, and that created overexuberance in activity from pent-up problems in 2008 and governments that couldn't learn not to spend, and that created inflation. Normally, we see full 20-year periods, not 15 years, for these interest rate cycles to really move and flood out, and for the development cycle to move accordingly. But this is a massive opportunity. I've been now through 2 of them. And the next one that comes will probably be another 10 to 20 years from now. That being said, we're taking advantage of the opportunity because we know the magnitude over time that does to your money and the wealth creation. We're diving into markets, how to underwrite, how to value facilities so you can know and do the same, so you can take advantage of this opportunity. So if you're interested, make sure that you're subscribed and like this video, guys. Tell me what you're seeing in your local markets. What are you seeing that's happening there? Overbuilt, undersupplied, because it's not going to go back the same. It'll be uneven, but we have shifted directions. And if you'd like to know more about my company and what we're investing in, make sure you check it out at Cedar Creek Capital and see what we're doing and how you can invest with us. All right, everybody. It's been a really, really hard 3-4 years. We've had assets that have suffered. We've had tons of our competitions left. They're gone. Developers eviscerated. But we're now changing course. The market's moving. I've been through this before. We were owning and operating, and in 2008, it was bad. And a lot of the people that were in the game with us were gone. And then they missed that buying opportunity and then that upside. Why? Because they're so stuck on performance of the past, they can't see the future. And they definitely can't understand the opportunity that presents itself, why they're hurting. That's hard to do. It's hard to balance here. All right, I'm struggling with this storage facility, or I know somebody that may be struggling. Occupancy is not great. Rates are down. And then also see the opportunity in it. But that's why there's opportunity. Because while there's less storage facilities being built, which creates abnormal low supply, there's also less people trying to buy. Whereas the top of the market, like 2020, 2021, 2019, and 18, everybody's flooding in. That makes less opportunity. So get in now, learn, don't make mistakes, evaluate the right markets, be careful, but take advantage of this massive wave that is a natural, reoccurring wave so you can have the ride of your life.